let us just kind of do a quick recap because a number of people joined late, and also we had audio issues, so we just resolved those now. So sorry about that. And yeah, feel free to leave questions for us in the chat box, and we'll get to those questions at the end. But just at a very, very kind of high level, we wanted to introduce ourselves. My name is Kenji, and this is Leticia. And we're married. We're both hospitalists. We work at Swedish Medical Center. Leticia works half-time. I'm a moonlighter. I focus mostly on our real estate portfolio, and together we've been running the Semi-Retired MD blog for the last year, almost 2 years now. And in terms of our experience, we have combined 23 years of real estate experience. By the end of this month, we will own 61 units, and we've owned properties in numerous markets. A lot of them are out of state. We've actually lived in Hawaii, so we managed all these properties out of state for a year and a half. And also, I mentioned that I'm the real estate person in our family, so I claim real estate professional status, and I've done that for the last 5 years, which then allows us to shelter our income, clinical income, other income, and we actually paid zero income taxes for the last 5 years. And then semi-retired MD. I mean, really, our focus. We're semi-retired, and so the blog for us is really a passion project, something where we are dedicated to helping physicians and other high-income professionals learn how to semi-retire like we have in Cashflowing Rentals, and so that's really what we've been focused on for the last couple of years with the blog. And so in terms of why Cashflowing Rentals and why we think this is really the best investment. Well, it's actually we actually don't even consider Cashflowing Rentals, which is here called active real estate. We don't actually view Cashflowing Rentals as even an investment. We actually consider each of our properties as a mini business, right? So let's say we have a four unit, right? That is we actually put that property in an LLC. And when we do our tax returns, I mean, that has income and expenses, and that is an individual unit. And so we actually consider these little mini businesses. And when you have a business as opposed to investing, you can get these really, really high returns of 25 to 200+% returns. And in some cases, and we'll explain how, we can actually even get infinite return, which means that you have no money down and you're just getting cash flow from that property. And if you compare it to any of the other investments, I mean, look at bonds, 1%, index funds historically, if you average it over 10 years, maybe 8%. Passive real estate, these are syndications. They can be anywhere from 10 to 25%, depending on the property. And then we talked about active real estate, which we're calling Cashflowing Rentals. And then so let me kind of break down that 25 to 200+% return. So when we say Cashflowing Rentals, the metric that we follow, the numbers that we look at, is we look at what's called cash on cash return. And what we're aiming for is 10% or higher. And not only that, we buy things that are at 10% or more, and then we're always trying to increase that over time. So we have some properties that started out at 10% are now at 40%.
And we should talk about what cash on cash return is. Right. So cash on cash return is basically the amount of money you make on the cash you put into the property. And so if you're not doing any rehab on that property, if you put $50,000 in as a down payment, you want to make 10% cash on cash would be $5,000 a year that you would make on that. If you put in rehab, then you'd have to factor that in and see the cash on cash percentage.
And then the next one is debt pay down. So this is when your tenants pay for your mortgage, so they're paying your rent, and then with that rent, you're paying your mortgage. And anytime you make a mortgage payment, your debt goes down. And so you're building up equity. I mean, for us, with all of our properties, our tenants are paying down about 50 to 60,000 a year in debt pay down. So that's how much equity we're building over
Right.
every year.
And that's money we never see, but it's actually money that's adding to our net worth over time.
And tax savings is the next one, and that this can be really significant, anywhere from 25 to 35%, or even sometimes actually even more, depending on how much income you shelter. And so, as an example, so for 2018 taxes, which we just recently filed, we sheltered about 350,000 of W-2 1099 income, and so we paid zero taxes on that. In addition, we actually had generated more losses than we actually needed. So we actually generated an additional 450,000 in losses. And these aren't real losses, these are paper losses. And so we're going to carry that 450,000 into 2019. And then this year, we're also going to buy another property that's going to create another $750,000 tax shelter. So overall, we're going to have about a $1.2 million tax shelter. So that's going to allow us to shelter that much income, $1.2 million worth of income. Anything we don't use, we just carry forward to the next year.
Yeah, and then we'll talk more about forced appreciation, but just quickly, what it is the amount of money that you're able to force the property to appreciate. It's very different from market appreciation, which you have no control over. You can actually force appreciation yourself. We'll talk about it in the next slide, but this is actually one of the biggest ways that we've made money in our properties. We have seen returns from 50% to 200% and more on our properties.
Yeah, and so it's funny. We call it cash flowing. Our course is called Zero to Freedom with Cash Flowing Rentals, but cash flow is really not the name of the game here. Forced appreciation and the tax savings that's really what this is about.
Yep. And then there's compounding from reinvesting the cash flow, the tax savings, and tapping into lazy equity. And when you do that every year, you don't live on your real estate income coming in. You actually just take it and put it back into real estate. You change your trajectory of wealth significantly over time. And that's how we know that it's possible for a lot of people to get to financial freedom in 5, 6, 7 years instead of 15 or 20 years with traditional investing.
Yeah. And we'll talk about lazy equity at the end. Essentially what that is when you force appreciation, you have all this equity in your property that you can actually use to either you can do a cash out refi and pull that money out, or you can sell your property in 1031 exchange, or do a tax deferred exchange and put that money into a new property without paying any taxes on it until the future. You're pushing that payment into the future. So this is just all the components of return illustrated in a stacked bar graph, and what we wanted to focus on here is just to show you that forced appreciation is a big component of the return. So is tax savings, and in terms of forced appreciation, the way you do this is by increasing income and decreasing expenses, and you can increase income in a number of different ways. But one easy one is when you buy a property that's just under market rent and you bring it up to market rent. Another one would be if you find other sources of income for the property, like, for example, putting in storage units. We also rent out detached garages for more income. And so those are just kind of two examples of how you can increase the income of a property.
Yeah, we teach all of these in our course as well.
Right.
Yeah,
right.
decreasing expenses. Those are things like billing back utilities. You know, making charts to show the tenants what part of the landscaping they're responsible for, and kind of pushing that cost off to the tenants. There are a number of ways to decrease expenses that will ultimately increase the value of your property on the market significantly and allow you to really take money out of that property in the form of lazy equity. And again, we'll show you this when we go through an example from one of our properties.
Okay, so then let's talk about so we talked about forced appreciation. So let's now talk about the tax benefits, because I think there's a lot of confusion about what are the actual benefits. And so the first one is that the cash flow is tax free. So, and this is really significant because when you think about let's say 100,000 in cash flow, what most people don't realize is that you're not taxed on that. And the reason is that because these rental properties are run like a business, you only pay taxes on the income, and the income is after expenses. So you have your rental income minus all your expenses, and then you're only taxed on the difference. And so, and with cash flowing rentals, even though you're cash flowing, you actually will typically be at net neutral or net negative. So you're actually showing a loss on a lot of these properties. And I'll show you an example of that on the following page. Now, the key with this one is that this is a benefit that is available to anybody who owns rentals. It doesn't matter how much money you make. It doesn't matter how many rentals you have. Anybody who owns rentals can benefit from this. And the key here is that if you make $100,000 in cash flow, it's actually equivalent to making about 150,000 in W-2 income. So, and the reason why I bring that up is that you don't have to make as much cash flow. You don't have to make the equivalent amount of cash flow as your W-2 income to make it up. And that's a really important thing to keep in mind. The second type of tax benefit, which is actually really the one that we think is the most significant one. I mean, financially, it is the most significant one. And this one is when you can shelter your W-2 or 1099 income. And so if you're a physician making, let's say, $300,000 and your spouse is the real estate professional, then you can set it up where you shelter all 300,000 in clinical income and you pay no taxes on it. So at the end of the year, you can get a $100,000 tax refund and reinvest that, or you could use it, for personal expenses. But it's obviously best if you can reinvest it.
Yeah, and that's only available to people who have real estate professional status, which again is a tax status that we have.
Right. And so let me kind of illustrate how cash flow is tax free. And so this is actually one of our properties that it's actually a duplex with rental income of $30,000. And then on the left, cash flow is calculated by just taking the income over here and subtracting the expenses. And this 5,500 is what you actually put into your pocket or goes into your bank account at the end of every year. But when you file your taxes, you have these same expenses, but you also have what's called phantom expenses. And therefore, because of these phantom expenses, you actually show a loss. And so what are phantom expenses? So phantom expenses are things that don't actually take money out of your pocket. So an example is depreciation. Depreciation is just a paper expense that the government allows you to take. It allows you to treat as an expense the decrease in value of your property over time. And your property, any property, residential property, depreciates over to zero over 27 and a half years. And that means that every year for 27 and a half years, you can expense that depreciation. And in this case, it was 9,600. Now, what's cool is that with the new Trump tax law, you can actually make this number even bigger. And in this case, we could have made this number maybe about $70,000 or $80,000. And the way we do that is by not depreciating the whole building, but depreciating components of the building all in 1 year, as opposed to over 27 and a half years. And something called bonus depreciation. That's again, something that is new since 2017, end of 2017. And that allows you to create these massive losses. And that's how we have that $450,000 loss from our 2018 taxes. But anyway, in this example, we also have, you can do a home office deduction. Again, that's just taking a room in your home and treating that as a workspace and deducting it. You also have phone and internet that you are normally just paying for, but you shift those costs to the business. And so when you do all that, then what's reported on your Schedule E is a loss. And it's about, in this case, about a $10,000 swing. And again, this is why you don't pay any taxes on your cash flow. So let me show you an example of real estate professional status in action. And so these are two of our properties, or three of our properties. This is our Schedule E, where we file our taxes. And so in this case, this is property B. This is how much rental income it generated, 26,000. These are our expenses. And you can see the big item here, $63,000 in repairs. And so what we do is we take those repairs and actually just expense them all in 1 year. And that's how we show a $62,000 loss on this property. This property here, we actually did about $200,000 in repairs, and this allowed us to show a $230,000 loss. What we did in 2018, and what we're actually going to be doing in 2019 is this line item here called depreciation. These numbers are going to balloon significantly. And again, because what we're doing is we're going to accelerate depreciation all into 1 year, and that's going to allow us to create these massive losses. And so we're buying a $3 million building, and that's going to allow us to make this number here $750,000. And it's going to create a $750,000 loss right here. And that's what's going to allow us to shelter and offset our W-2 or other income. So let's just kind of talk to you about an example property. This is a property south of Seattle, and it's a duplex that we purchased for $224,000. And as you can see, it's really nothing special. It's I would call this a B minus probably, or maybe a C plus property in maybe a C neighborhood. Maybe it's a C plus neighborhood. And oftentimes on the fence we'll get graffiti and stuff like that. It's a real pain, but anyway, this is a property that we purchased for $224,000.
Yeah, and this is just one of our average properties. This is not one of our stellar ones or anything like that. We just wanted to show you like what a normal, plain old average Jane deal looks like.
Right. Yeah. And actually we feature some of the really good ones in our course. This one we just kind of pulled out because it was just an average one we wanted to show you. So let's kind of talk about each of the different categories. So we purchased it for $224,000. The bonus depreciation I'd mentioned, that's going to allow us to create a $50,000 loss on this property, which is going to be about a $15,000 tax savings at 30% tax rate. Renovations, we put in about $70,000 in renovations, but when we do renovations, we write those repairs off. And so that $70,000 was a loss on this property. And so that represents about a $21,000 refund at a 30% tax rate.
Yeah. And the way I look at it is the government pays for a quarter to a third of any rehab we do, which is pretty amazing because we get to take all the benefit of the increase in rents, but the government's paying part of the rehab.
Right. And then what we were able to do here was we were actually able to increase the rent significantly from $1,800 to currently $3,000. Plus, we also bill back utilities. So we actually completely eliminated utility expenses. And what that did was it significantly increased our cash flow from $6,000 to over $12,500 a year. And then the value after renovation, this is what we mean by forced depreciation. After 6 months after or I should say, immediately after we rented the property after the renovations, this property was now valued much higher. It was actually valued at $475,000, and we purchased it for $224,000. But again, valued at $475,000. Actually, that $475,000 has a little bit of market appreciation in there, but $475,000, a large part of that is forced appreciation, and so therefore, if we were to either do a cash out refi or if we were to go sell this property, we have about $300,000 in equity in this property after paying off the mortgage, which would allow us to go out and buy a $1.2 million property. If you put down 25%, $300,000 down would allow you to buy a $1.2 million property. So as you can see, we went from a $224,000 property and stepped up to a $1.2 million property.
If we sold it.
If we sold it, right, exactly.
And 1031 exchanged it, which is what you can do to move the money from one property to another tax deferred.
Right. Another option is we could do a cash out refi. We could keep this property, but get a new loan on it and pull out some of this $300,000. You couldn't pull out all of it, but you could pull out a portion of this. And what's cool about this actually is that we could actually pull out all of our invested money, right? And the return on this would be infinite, right? Our cash flow would be a little bit lower because our mortgage payment would be higher, but still that cash flow, whatever cash flow we're making from this property, would be infinite, right? And then we could use that money and reinvest it into a new property. And so you can
And
imagine
then
just
that would make 10% cash on cash, and we'd be able to get, the depreciation on that property. And then just, again, we'd have all that money working for us again.
right, exactly. So, this is really the benefit here of cash flowing rentals. And, as we mentioned, if we do this, imagine doing this for, 5 properties, and you take all of them from 224,000 to 1.2 million. And we've only owned this property for, let's say, 3 years. Imagine what you could do in a very, very short amount of time. It's very, very significant here. So, and again, this is our average properties. We have properties that have performed, way outperformed this one. But again, we didn't want to kind of show you too many, sorry, too much in terms of, we just wanted to show you the average kind of deal. Just kind of looking at some questions here. Was the cash flow purely from rent? So the cash flow on this one is purely from rent. And so, the cash flow is income minus the expenses, including the mortgage payment. And so it's just pure, it's essentially income, right? And so if you kind of look at this here, the cash flow, that the 12,500, right, that we made on that one property is income minus expenses. And then you get that number here. This is what we put in our bank account, what we put in our pocket. And that's what I'm talking about here when I say cash flow per year on this property is 12,500 after all expenses. So, okay, looks like I got the thumbs up there, so I answered that question. All right, yeah, and if you guys have any questions, please feel free to write them in the chat box, or we'll open it up for questions at the end here. So let's kind of shift to our course, and really why we're doing this webinar is that our course is currently open for registration and it's only open for registration for 2 weeks, and then once that happens, we close the course, and then we have we essentially start. All the students that sign up for the course go through the course together. And again, the reason why we do that is that we're very involved in the course. We do weekly live Q&As just like this here. And we also are very involved in the Facebook groups. And so that's kind of why we do it that way. And we're only going to open up the course. Our plan is to open it up twice a year is what we're looking at. And so, this is a question we often get. Who is this for? Is this only for new investors? No, it's not actually, but we do focus on new investors. I mean, this is really for somebody who has little or no real estate investment knowledge. And, the goal here is to get you to a point where you're very comfortable and going out and buying properties and replicating exactly what we had done with our properties in terms of buying the right properties, buying it at a discount, by focusing on things like off-market properties, knowing how to increase the rents and decrease the expenses, knowing how to force appreciation, and then knowing how to tap into that, right? So we're going to cover all that. We'll also cover real estate professional status as well.
Yeah, and we also teach people how to build a team and a bunch of other things as well.
Right.
Yeah, but we've also, besides newbie investors who know nothing about real estate, we've actually had a number of advanced investors who own multiple properties go through our course, and they've gotten a lot of value out of it. Not only in tips and tricks that we've done that they pick up along the way of the course, but just the community is so powerful in giving support and encouraging each other that for advanced investors, they've gotten a lot of value out of that as well.
Yep. Yeah, we had one investor tell us that, or one student tell us that, yeah, they went back to their portfolio and I think
made changes. He rented out like storage units, and he did all kinds of things based on what he learned in the course. And he said he got like a 100x value on the course just in those 8 weeks.
Yeah. And then, in terms of what the course consists of. So, we talked about the first one already. You're going to learn our exact same strategy that we used. We also talked about the next one. You'll work directly with us. I think the third bullet here is really, really significant. It's I think it's really underestimated how important this is. But but the idea of kind of surrounding yourself with the right peer group of kind of like-minded high income earners, most of them are physicians, and it's just really amazing in terms of how much how open people are, how much sharing there is.
Right.
One of the rules coming into this um, when you join what we call team investing. So what we have our course community, but we also have these other communities called team investing groups, which is whatever market you choose, you're going to also have these subgroups where you're going to focus on a particular market like Phoenix, and you're going to all work together. And one of the rules of joining that team investing group is that you have to approach it with an abundance mindset. You have to be willing to help and give more than you actually even receive. And so what's so cool about these groups is that people are posting, off-market deals that, that they don't have the money for, but, their agents brought to them and they're like, hey, anybody want this deal? I don't have the money for this right now. And so that's one example. People are sharing contacts,
Contractors, property
contractors. Yep.
managers, yeah, all kinds of things.
Yeah. So it's really great. And then also just in terms of like, we all have a shared experience, right? So they're all talking about asset protection and talking about, all the things that a high income earner has to deal with in terms of taxes, right? So that's what's cool about it, is that you really kind of surround yourself with the right people who are really pushing themselves, and that actually really pushes you to like want to push even higher. And we'll share some quotes from some of our investors. We'll tell you a little bit more about what they've been able to do during the course. Pretty exciting.
Yeah, I want to just add one more thing
Yeah.
is we train everyone to use our cash and cash calculator. And so
Right.
everyone speaks the same language. And so
Right.
I think one of the highest values is actually when somebody goes through a deal and they're really thinking about buying it, they'll post the cash and cash calculator in our group and multiple people will comment on it. I think part of the reason that Kenji and I were so successful for so long is we had always had two heads in the game.
Right.
And if one of us didn't like a deal, we blocked it. Or if one of us saw something that the other person had missed, it was really, really helpful to keep us out of getting in trouble. Well, in the team group, you have 100 docs looking at your deal and giving comments, and that's just an amazing thing because now you have multiple heads in the game, and they'll pick stuff up that you didn't even think about.
Yeah, and I think avoiding mistakes is really huge. I mean, I'd say because we've had each other, but also good teams. I'd say the mistakes over the last 5 years, really, we've kept at a minimum. And I'd say almost all of our properties have performed at expectation or even better.
Yeah, I
So,
agree.
And then also, we're also going to give you access to our membership site after the class, which you can use to continue learning, advanced skills. I'll let you handle this 1 second.
And then you also get access to our vendors. So in their course, we introduce everyone to our lenders, the ones we've used for the last 5 years, our insurance agents, and then the people, really the tax accountants, the people we trust to have managed our portfolio. We're happy to share with our class. Finally, you get access to an exclusive network of investor agents that we've created. And these are investor agents across the country. A lot of our students have already used them. We're always expanding and adding new agents and getting rid of ones that aren't performing up to our expectations. So it's a continually growing thing. And we do help our students choose markets. Some of our students want to choose markets that are not on our list. And if that's the case, oftentimes we'll go and try to find investor agents for them as well. Sorry. So here's an example of some of the places our investor agents are currently, and again, this will be growing all the time. We try to choose in landlord-friendly states where there's still cash flowing properties. And so that's part of risk mitigation, which is very, very important to us. And we feel like it's important to a lot of our students too. So we try to choose states that they're going to be long-term, have great markets for rentals, 10 or 20 years down the line. So these are some of our student results. We can come back to this page so you guys have time to read it. But this is just from our last class, some of the students that we were able to help. And someone like Dr. Matthew Schaefer down here, they're going to end up with almost 30 units. And it's what, 3 months after our class finished.
Right. Gretchen Green here is going to be, I think she's going to be at 40 units at the, and again, all these people just took our course this last round the course went from
August through
yeah,
October.
Yeah, August through October. Dr. Jane Yu actually bought a property during our course, which is cool. And so I'd say all of these people have actually probably bought anywhere from,
Sunny Smith,
Sunny
she's
Smith,
going to
she's
be at
looking at
like 18, I
18
think.
or so units. Yeah. So pretty amazing actually how much progress people have made in very, very short amount of time. So, okay. So, and then that is another thing, actually, one of the things that we're doing is that anytime we come across deals, we'll actually post them in our, we'll actually first, and some of you may have seen one off-market deal pop up in the semi-retired physicians group. But we typically will only post them in our course community or our membership site community. And everybody, that group will get the first dibs on these deals. And so, yeah, Gretchen Green got the 32 unit, or yeah, so I think it was a 32 unit, and Dr. Matt Schaefer got the 30 unit. So yeah,
28 unit, yeah.
29 units actually.
Yeah,
So
off of the membership site. And actually, I
right.
don't know that we mentioned the membership site, but it's basically kind of a monthly ongoing education that kind of delves in deeper than what we cover in the course. And so all of the students who come into this version of the course are going to get 2 months in our membership site for free after you finish it. So that will allow you to get some advanced education and then to form connections with people from previous classes who are in the membership site.
Yeah. I mean, I kind of look at it as a continuation of the course, really, and to kind of provide ongoing support and kind of, help you on your journey. Not just about, the course is about getting you started and getting you comfortable purchasing your first property. And for some of these people, they've bought more than one property, but really, it's getting you from that point to all the way to, um, you know, till you have your real estate empire, and that's why we call it Empire Builders is our membership site. So, so there's a lot of steps in that journey, and so kind of during the membership site, you'll be kind of going on that journey with us. So this is the link to our course, and one thing that we feel strongly about is our money back guarantee, which is that if you don't make more progress in the first 3 weeks of the course than you have in the last year, we'll refund your money, no questions asked. And so I think this is one of this in terms of progress. I think one of the things that people have a lot of trouble is with getting started, and I think that's one thing our course has been really great about is getting people started. I give you an example. A friend of mine who took our course, they were stuck really for 3 years, just reading books, listening to podcasts, and they just didn't make any progress at all. And once they took our course, I mean, within a month after taking our course, they had put in multiple offers, and they finally were able to get their first fourplex, and that was about a month or so after the course. And so, but prior to that, 3 years, just no progress at all, and that was really exciting to see. So I think that's one thing. I think another thing that I oftentimes hear from people is, and I've been getting a lot of emails and messenger messages from people about, is that people are always asking me like, well, I either don't have the money right now, or or I'm I'm just I'm not planning on doing this for like another year or two, for whatever reason, right? And so I think that, and people always ask that question. They're like, oh, is there a later version of this course? And yes, there is going to be a later version of this course. We're going to have this course launched again. But for the people, especially for the people who say they don't have money, I think that in terms of your education, I mean, the sooner you get started, the better. Sure, you can wait, but I think knowledge and education and your network is cumulative. It takes time to build those things, and so the sooner you get started, we think the better, just because. The other thing is that by the time you're quote unquote ready, um, you know, uh, it'll take you from that point time to build up that knowledge and network, right? And you could have had all that done already. And then, by the time you are ready, you could just hit the ground running and go. I think the other kind of misconception is that people always assume that you need money, and certainly it's easier if you have money for a down payment. But I would say that for you again, you will have to know a lot in order to be able to pull off no money down deals. But there are ways to invest where you can invest with no money down, or ways where you can
recycle the same amount of
recycle the
money
same amount
over
of,
and
yeah.
over
So if
again.
you have a nest egg of some sort that you could use, buy a property, renovate it, and then you can refinance and pull the money out, and then recycle that same money over again. I mean, we know somebody who's bought 60 single family homes in 1.5 years. 60, just recycling that same amount of money. And of course, that's all they did. That was their life. But I mean, like literally, I mean, it was like just this like they have this crazy portfolio now doing that. Again, you have to be educated. You have to have the right network, relationships with banks. It's so key with agents. You have to know the right agents who are bringing you these deals. But if you're able to do that, then you're going to be able to pull off that type of no money down strategy.
Yeah, and even in our current property that we're buying, the 32 unit, we're gonna in 18 months. The goal is actually to take all that money out and reinvest it in another property.
Yeah.
So let's talk about a couple questions we got in here. Um, I've been suggested by property managers to use Rentometer. Is that a good resource? Yeah, so we do encourage our students to use Rentometer. There are a couple weaknesses of it. So Rentometer, for those of you who don't know, is actually an app, and then there's a website version. The app you can use over and over again for different properties. So we use the app, whereas the website version, after you've looked up a couple properties, it'll kind of block you from doing more until you buy a subscription. But the app on your phone you can use. It helps you, you put in an address, you put in the number of bedrooms, and it gives you an estimated average rent. The weaknesses of it is it's based on what rent it gives you is based on what else is for rent in the area. And so if people are listing their properties, $100 more than they should be in the area and they're not renting, your number that you get as an estimated rent on Rentometer will be inflated from the actual rent number you'll be able to get. And then it doesn't take into account things like number of bathrooms or square footage, which can make a big difference in the rent amount. So it's a great kind of first pass resource to give you an idea of what things are being listed for rent in your area. But the gold standard is really a property manager and getting your property manager to look at the pictures and tell you how much they think it's going to rent for. And a good property manager can do that even without going on site and seeing the property. They'll be able to look at the pictures and have an idea because they see so many properties cross their desk every single day. The second part of that question is, seems like when you renovated your complex, it was easier to increase the rent exponentially. And that's exactly true. So when you put in money to rehab these properties, you force appreciation of the properties and you'll force rent appreciation. The amount you do that far exceeds the amount you've put into rehabbing the properties if you've done it right. And by that, I mean, you've put in rental grade finishes. You've not gone crazy and done things like stainless steel or granite countertops if it's not necessary to increase rents in your area. So you have to do it smartly with a contractor who really understands what is expected in the area for rental grade finishes, and then also in conjunction with your property manager's input to know, what changes you're going to make if they're going to increase rents or if they're not going to make a difference at all. And so if you have that good team in place and you go in to rehab a property and you're being very thoughtful about, what finishes are going to increase rents, you can get much, much more money out of your property than you put in the rehab. And that's how we've made a lot of our money.
Right. But again, one of the easiest ways to tap into hidden value is to find a property that is just being mismanaged. I mean, the 32 unit that we're buying is just horribly mismanaged by an 80-year-old owner who thinks he knows what he's doing, and eventually broke down and hired a property manager, but essentially is not letting the property management company do their job because he's micromanaging everything. And so property management company is just kind of given up. And so, so it's just a good example of a horribly mismanaged property that we're going to be able to purchase and just raise rents. I mean, the first thing we're going to do is we're going to send a 60-day notice to raise rents to market rent. We're going to go up from 750 to 950. Are we going to lose tenants? Sure, we probably will, but we already have that plan in place where if we lose tenants, we're just going to renovate those units and bring increase the rents even more than by renovating it and increasing that rent. So that's a good question. I think there was another question here from Michael, though I can't actually see the question. I'm not sure what the question is, but I don't know if Michael, if you can also, if you want to put your speaker on, you can also do that. Michael, did you want to ask your question, or anybody else have questions? Feel free to chime in, or. Okay. Is that it here?
Yep.
Put it here. So let's see. So there's a private question to us. So how important is it to visit the properties you purchase? So great question. I think more than visiting the property, what's most important is that you visit your market and get to know your market and get to know the people there. Because if you have people who are there who you trust, who you have a relationship with, then you can do a lot of this sight unseen. And so when we go into a new market, for example, we went into Spokane, what we did was we just got to know our agent, we got to know our property manager, and we spent a lot of time just driving around, getting to know the different neighborhoods.
Yeah, we went there for like 2 or 3 days initially.
Yep. And then from there, actually, in that first trip, we bought a couple properties, but after that, we just bought things sight unseen, and those have been working actually really beautifully for us. Pretty amazing. They've been operating really well. So I think in terms of your question, it is important to visit your properties if you can. And I think a site visit is always great, but more important than that is a market visit.
Right.
And we we'll talk more in the course about kind of what you need to do in your market visit. What you want to look for.
One of the keys is really having your real estate agent bring you off-market deals. And these are the deals that never show up on the MLS. That nobody else has access to them. And the way you get your agent to give you an off-market deal is if they really like you and they know that you're a good investor, you're going to follow through, you're going to act quickly, and you're not going to flake on them. And part of that is just having that relationship with them, that they've seen that you're willing to make a visit out there, that you're willing to meet them in person, that they, have that connection with you and that level of trust. And the same thing for you, that you're able to trust them because you've met them, because you know what they're about, because they've taken the time to show you properties. And once you develop that level of trust, then they do a Facebook Live and they show you the property during inspection, and you trust them to be able to act as your kind of boots on the ground. And all you need is that Facebook Live, and you
FaceTime.
FaceTime, and you feel like totally fine. And so that's why we bought a lot of properties off market, sight unseen, from investor agents that we trust.
Yeah. Here's another question. Does it end up that you are managing many property managers across different states? Yes, absolutely. And overall, it's I think right now I think 5 property managers maybe
1, 2,
across.
3.
So something like that. And we're actually self-managing one property using a software called Hemlane, and that's going really well. But yeah, you do have to end up managing multiple property managers as you build up your portfolio. But I kind of like to put that in the category of good problems to have. I mean, if you have 15 properties and across many states and you're cash flowing well, then it's kind of a good problem. You can always listen, the thing here is that you always have choices, right? I mean, if you have 15 properties, one of the things that we're doing, and actually this is driven by that the tax law change, is that we're 1031ing we're selling a lot of our properties and moving them into bigger properties. So over the next couple of years, we'll our portfolio will shrink in terms of numbers of properties, but each property is going to be much bigger. So we're going to buy a 32 unit here in December, and then we're planning to buy another 30 to 40 unit, 30 to maybe 50 unit next year. And so in order to buy that property, we will probably sell a couple properties in order to buy that. So, over time, it's going to, we're going to be working with fewer property managers.
Right. Part of
probably.
why we work with so many property managers is we bought in such geographically distant locations. And we did that for risk mitigation for ourselves. We really wanted to be in multiple markets so that if anything happened natural disaster wise or anything in the local economy, we wanted to have multiple areas. And then also shifting over time, it's been really valuable for us to have different properties in different markets, because let's say one market takes off, like the Seattle area has taken off, we're able to actually take advantage of some market appreciation in there and sell our properties and move into other markets that are still not yet taken off, and our money makes more for us in those types of markets.
Yep.
Okay, if there aren't any more questions, we're going to wrap up the webinar. So we'll give you guys another 30 seconds to get a question in. Okay, good.
That was 30 seconds?
That was close enough.
Okay, close enough.
Thank you guys for joining us. We really appreciate it.
Thank you.
We hope we see you in our class.
Okay, we'll see you later. Thank you.